Hey guys, what's going on here? This month I wanted to highlight conventional loans, the Rolls Royce of loans, the loans that everyone prefers to get if you can. It's the loan that sellers like to see you get if you have to get financing. Let's jump into the 5 things you need to know, what makes these most attractive, and what you need to know before you start applying for these. So number 1, credit score requirements. Conventional loans are going to be a lot stricter in terms of your debt to income ratios and your FICO scores than, like, say, an FHA loan will be. So generally 620 is the magic number. If your FICO score falls below that, of course we have other programs for you like FHA mainly, but 620 is going to be across the board. Most all banks out there are going to require that for your minimum FICO score. Number 2 we go through is down payment size and the misconception that you need 20% down. So you do not need 20% down by no means. I'd say probably 50% of the clients that I help with this type of a financing don't have a full 20% down. 20% down is going to go through that where you don't have to deal with mortgage insurance. So that's where a lot of people feel or have heard you need 20%. You don't have to. You can get away with a little as 3% down on these programs. We have a conventional loan that has a 1% down program. So you don't need a hefty down payment, but that's going to lead me into number 3 is mortgage insurance. So number 3 is mortgage insurance, or PMI. So what is that? So if you do have less than 20% down, which is a lot of people, you're going to have to pay mortgage insurance in some way. Now, that's going to be in the form of like monthly mortgage insurance or upfront or finance, multitude of ways of which might work best for you that we can suit you to have to pay that mortgage insurance, but it doesn't protect you. It protects the banks if it goes into foreclosure and for any kind of shortfall that they have on their loan amount. Now, the good news is that the mortgage insurance will go away when you hit that magic equity level. So if you have 10% to put down, that's what's the best you can do. When you get the other 10 that you reach that 20% equity level, by all means, yes, you can ask to get that removed, or maybe the house appreciates that you have the equity in there now. There's a couple different ways, a couple different strategies I go through with my clients that we can work with them on making sure we get rid of that mortgage insurance as soon as possible, but it will be on there until we can come up with the best way to get that removed for you. So that moves us into number 4 is going to go property inspections, and why a lot of people like this is the fact that conventional conforming loans, Fannie Mae, Freddie Mac, do not require any kind of water tests, well or septic distances that I noted in my FHA video. If you're not checked that out, it goes through that in there. So that's really, really nice. The only thing they do flag now and again, if the appraiser goes to the property, I've had this happen, if it's a health or safety issue. Literally, I had one time where there was a very large hole in the floor on the 2nd floor that you could look through and see the bottom. It was kind of a gut job renovation loan anyway, but needs to say, that's going to be a major safety issue if someone falls through there. So, of course, that had to get fixed. But this isn't going to flag for like chipping, peeling paint or missing handrails like an FHA loan will. So this is why sellers really like this loan. A lot less hassle you have to deal with in property condition and fixing the property. So, again, it's a stricter loan to get, but it's going to be more forgiving unless it's a big health or safety issue type situation. So that leaves me number 5. What kind of programs are on this? So when you hear conventional or conforming, kind of means one and the same thing. It conforms to Fannie Mae and Freddie Mac requirements. It's not backed by any government entity like FHA or VA or USDA. So that's why it's a little nicer in terms of they're a little more loose on their requirements and going through with it. Also, you can have them in fixed rates. You can have them in ARMs or adjustable rate mortgages. You can also have them, there's certain thresholds depending where you purchase on loan amounts, how much of a loan amount. Right now, the conforming loan amount is all the way up around $800,000. We can still write loans well into the millions, but that might be a jumbo loan. So just different loan amounts you have to kind of look for. Again, case specific, but you can get them on a myriad of different programs. Most people still get the standard 30-year fixed rate mortgage. That's really still what they're looking for. So overall, these loans, by all means, if we can get you approved, if you need financing for a conventional loan, it's going to give you the biggest leg up for a seller. If you're watching this and looking around at different mortgages, some people have to get into an FHA. It's not the end of the world. I have tons of clients that we get approved for VA or FHA or whatever it is, whatever best suits you, that's what we're going to look into. But sellers will prefer this kind of financing if you can get it. So it's something to be mindful of. Any questions, let me know. Kind of like those 5 things. There's a ton of more talking points. If you have specific questions, please feel free to reach out. Let me know on your specific situation. I'm happy to help. All right, guys. Talk to you soon. Have a good rest of your day.